So it's another perfect evening. We have met students of financial reporting and analysis. So for today, we are going to tackle the RAS sitting question. So RAS sitting, I mean the sitting for December 2024, question number 2. So this question comes from Consolidated financial statements, or we call it group accounting. So I will be reading the question. We go through it. We talk a bit what they were asking under the additional information. Then we look at the requirement. Then at the end, we'll be able to do the presentation based on what they require. So this is the relevant question. This is the relevant question here, which I will show on the other end. This is the relevant question. This is F, that is financial reporting. That is financial reporting and analysis. Financial reporting and analysis. Question number 2B. Question number 2B. Question number 2B. On 1st November 2023, KIP Limited acquired a 75% of interest in Lima's equity shares. The acquisition was completed through a share for share transactions, where KIP Limited exchanged 2 of its share for every 3 Lima's Limited shares acquired. On the acquisition date, KIP Limited's share price was shillings 40 per share. So here you are told that there is a company called KIP which is acquiring Lima, 75%. 75. So what you need to know about consolidation is that when an entity is acquired, when an entity acquires another one, like now here we have KIP, which is acquiring which company? Which is acquiring Lima. KIP, which is acquiring another company called Lima. So the percentage of acquisition is 75%. So this is what you need to look at. So this is 75%. This percentage is what will tell us which type of company is this, which type of investing company is this, investing company is this, which type of investing company is this. Remember that when a company is acquired between the percentage of 20% to 49%, like now, when this company acquires another company between this percentage, this one will be called an associate. So if it's exactly at 50%, that company will be called a joint venture. If the percentage is between 51% to 100%, 51 to 100%, this company will be called a subsidiary. This company will be called a subsidiary. So this company acquiring these companies, so I'm giving an example. So this company acquiring these other companies here between the percentage of 20 to 49 maybe, which we have called an associate, exactly at 50%, which we have called a joint venture, 51 to 100%, which we have called a subsidiary. So this company will be called a parent. This is a parent, or we call it an holding company. We call it an holding what? Company. We call it a parent or what? Holding company. So you need to understand about the percentages. Then they went ahead to say that when this company was acquired, now meaning that the Rima is a subsidiary. That is what I was just interpreting. So Rima is a subsidiary. So KIP is a parent company. Then they went ahead to say that when this other company was being acquired, they did what? They did a share exchange. They did a share exchange. So today you are acquiring something. Let's say even it's an asset. You are acquiring something. Let's say it's an asset. So if you are acquiring an asset somewhere, you have to pay something. You have to pay money. You can pay cash. Let's say I'm a company, I'm acquiring another entity. I can pay money. I can do share exchange. It's not a must I pay money. I can do share exchange. I can give you 2 shares for every 3 you have. And for every 3 shares you have, I give you 2. For me to take you over. for me to purchase you. So, and that's what they are showing in this question, that there was a share exchange. There was a share exchange. And another thing you need to know is that this amount I'm paying, it's not a must I pay the full amount now. I can say to pay some cash today. We have agreed I was to pay 5 million today. I can pay 2 million today or 3 million today. Then I tell you that, let me look at your business profitability. Then I pay you the balance after 3 years or after 1 year. So if I decide to take that channel of paying some amount in the future, that is what we call deferred consideration. Deferred consideration. So when we have the aspect of deferred consideration, we need to do what we call discounting or compounding. So when there's a deferred consideration, you need to do a discounting so that you determine the future amount which was paid, its present value currently when the business was done what was both. All these aspects, we'll look at them. We'll look at more illustrations from the past papers, and some of them I've already done them. So for now, let's concentrate on this sitting question. Let's concentrate on this sitting question. So here, we were saying that the acquisition was completed through a share for share transactions, where KEEP exchanged 2 of its own shares for every 3. 2 for every 3. 2 for every 3. So there's exchange of 2 for every 3 shares. 2 for every 3. On the acquisition date, KEEP Limited's shares, KEEP Limited's share price was shillings 40. So KEEP Limited's share price, KEEP Limited share price, KEEP Limited share price was what? Was shillings 40. Summarized below are the statements of profit or loss and other comprehensive incomes for KEEP Limited and RIMA Limited for the financial year ended 30th April 2024. So you are given a statement of what? Statement of profit or loss. Then we have our details of equity as at 1st November 2023. Details of equity as at 1st November 2023. Details of equity as at 1st November 2020 before acquisition. We have ordinary shares, share premium, revaluation reserve, equity reserve, and retained earnings. So you can look at our ordinary share capital. Our par value is ordinary share capital. So there's something I need to do here. Ordinary share capital, because I need to analyze everything before we do this question. So for understanding, ordinary share capital of shillings what? Shillings 10. Of shillings 10 each. Of shillings 10 each. Of which under KEEP it's 1 million. The value is 1 million in terms of shillings. And under RIMA is 640. Under RIMA is 640,000. Under RIMA is 640,000. Under RIMA is 640,000. Under RIMA is 640,000. Now you need to apply this share exchange. You need to determine what? Determine purchase consideration. Simple like that. Determine purchase consideration. The essence of going ahead to provide net assets is to assist you in the determination of purchase consideration because it was not given direct. They have said that KEEP acquired RIMA 75%. He acquired 75%. Then when they were paying, they did a share exchange of 2 shares for every 3. 2 shares for every 3 shares. But we know that KEEP acquired 75% of the shares. The shares is 640. But remember, 640 is in terms of shillings. So the number of shares is divided by 10. Divided by 10, the par value. So we have 64,000. So we acquired 75% of this. 75% of that is 0.75 times 64,000. That is 48,000. So 2 for every 3 shares. What about 48,000? What about 48,000? So 48,000, we talk about 48,000 times 2 divided by 3. So that is times 2 divided by 3. So that is 32,000 shares. So meaning that keep limited acquired 32,000 shares. 32,000 shares in what? In RIMA. We acquired those shares in RIMA. So for you now to determine our purchase consideration, it will be, so you'll come here and say our ordinary share capital will be, now this is the purchase consideration, it will be our ordinary share capital will be, so the 32,000 times what? At par value. Remember, the ordinary share capital is measured at par value. The par value is 10. So that is 32,000 times this, it will be 320,000. 320,000. But remember that keep share price. Keep limited share price was 40. So if Keep was to sell these shares, because he has acquired these shares in RIMA, if he was to sell them currently, he will sell them at 40, of which the par value is 10. So he will sell them at an excess of 40 minus 10. That is 30. This 30 is called share premium. The excess share premium. The excess is called share premium. So share premium will be 32,000 times the 30. So that is 32,000 times the 30. So we have 960,000. So 960,000. So 320,000 plus 960,000 will be. So I need to confirm something. Yeah. So that will be 1.2. And that is our purchase consideration. That is our purchase consideration. Have you seen how we have computed the purchase consideration when there's a share exchange? When there's aspect of share exchange, this is how you compute. This is the long way, or which for my case I can do it in a shorter way. But this is the way. This is the long way, which can make you understand on how they arrived on how you are supposed to arrive at 1.2. So we move to the next addition information, because we are done with the first addition information. I think you have understood on how to do it, on how to determine the purchase consideration using what? Share exchange, when this aspect of share exchange. So the purchase consideration is 1.28. 1.28. 1.28. That is the one we'll be using when computing for goodwill. All right. Additional information number 2. Keep limited follow a policy of revaluing land to market value at the end of each reporting period. RIMA Limited had previously measured its land at historical cost before being acquired. Since the acquisition, RIMA Limited land increased by 4 million in value, which it has recorded in its financial statements. So that is just a revaluation gain. That is just a revaluation gain. There is a gain, revaluation gain, when an asset increases in value. So the revaluation gain, debit the relevant asset, credit the revaluation reserve account. Credit revaluation reserve what? Revaluation reserve account. Credit the revaluation reserve account. Number 3, after the acquisition on 1st November 2023, Keep Limited transferred plant and equipment to RIMA at an agreed value of 20 million. So there's this sale of an asset from Keep Limited, the sale of fixed asset, sale of It's a transfer. Let me use that word they have used, because that is even the word I will be using when I will be introducing this topic well. Today, I'm just welcoming you guys to the start of a financial reporting and analysis class for the January to April semester. So when I start a class, I always pick one question for the previous sitting. I do it. Even if yes, I will be doing all other questions and share. I will be doing all other questions from number 1, number 3, number 4, number 5, and share them. But that is for the students who could have joined my Zoom classes. That is for the students who could have joined my Zoom classes. The likes of Fidel from Rwanda, they are around. The likes of Moses, they are around. These other students who are, yeah, anyway, we have a group for the students who have joined. The likes of Abigail, they are around. So there's a Zoom class for these financial reporting and analysis, which takes place on Wednesdays and Thursdays from 8 p.m. to 10 p.m. 8 p.m. to 10 p.m. every day. We do financial reporting and analysis. We introduce a topic. We do illustrations from the past papers. I don't construct my own questions when doing illustrations, but I do illustrations from the KASNEB past papers. Let's talk about number 3. After the acquisitions on 1st November 2023, KIP Limited transferred plant equipment to RIMA at an agreed value of 20 million. So transfer of plant and equipment, plant equipment. So there's this transfer of plant and equipment from KIP to RIMA. So selling price is what? Selling price is 20 million. That is 20,000 in terms of thousands. This equipment had a carrying amount. Carrying amount was, so it had a carrying amount of 16 million. That is 16,000. Carrying amount of 16,000 at the transfer date. And the remaining useful life is 2.5. The remaining useful life is 2.5 years. 2.5 years. KIP Limited accounted for the gain from these transactions by reducing its depreciation expense. Very important. By reducing what? Depreciation expense. Depreciation is charged to where? To cost of sales. So we'll be adjusting our cost of sales accordingly. So what am I supposed to do here? When there's a transfer of a plant and equipment? What comes into your mind? A plant and equipment is a fixed asset. There's this parent which has sold this plant to a subsidiary. It has sold this plant to a subsidiary. These are group members. So that is another thing I need you to know, that when you are talking about parent and subsidiary, these are the owners of the group. These are the group members. Associates and joint ventures are not group members. We don't consider them as such. So we only consider some of the transactions between parent and subsidiary because they are group members. So here we have parent transferring a fixed asset to the subsidiary. When he transferred this, it transferred at a profit because we can see the selling price is 20, the carrying amount is 16. So he sold at a profit of 4,000. Remaining useful life is 2.5 years. So there's no way you are told that when this subsidiary received the asset, he made a resale. There's no way you are told, and you can never be told that. The only way you can, the only point where you can be told that this subsidiary made a resale is when you are dealing with goods, not a fixed asset. And that will be my next additional information. We'll be talking about goods. For now, we are talking about fixed asset. So for the fixed asset, when there's a transfer of a fixed asset from the parent to the parent expects that this subsidiary, or this is what is supposed to happen, this subsidiary will be using this asset for the business purpose, not for a resale. This one means this subsidiary, since it will not resell, it will never resell this fixed asset, it will never realize the profit the parent made. This profit of 4,000, which was made by the parent when he was transferring these asset here, will never be realized by who? By Lima, because Lima will never resell that fixed asset. In consolidation, we need to avoid profit overstatement in one of the company. So we have profit overstatement here. We have profit overstatement here because it transferred the fixed asset to this entity, and this entity will never resell that fixed asset. So we need to eliminate that unrealized profit on fixed asset under keep. Unrealized profit on fixed asset under who? Keep. We need to eliminate it. And this is determined by transfer value. So this is unrealized profit on fixed asset, UPFA. This is determined by transfer value of the asset, transfer value of the asset, transfer value of asset times what? Times profit margin, times profit margin, times the profit margin. So remember that it was transferred at 20,000. Do we have profit margin? No. You can compute it. Very simple. We say that profit margin is equal to what? Profit margin is equal to profit over selling price. Profit over selling price. Profit over selling price. The profit, you know, is 4,000. The difference, 20,000 minus 16. Divide the selling price, which is 20,000. This one goes with this. So meaning that this is 1 over what? 4 divided by 20. That is 1 over 5. 1 over 5. That is my profit margin here. And that one gives me what? 4,000. So this profit must be eliminated. Eliminate it to avoid. Eliminate to avoid what? To avoid profit overstatement. To avoid profit overstatement. Eliminate to avoid profit overstatement. How do we eliminate it? Debit which account and credit which account? Debit which account and credit which account? For profit elimination, debit retained earnings account. Retained earnings account will be affected. And at the same time, credit what? Credit the property, plant, and equipment account. The property, plant, and equipment account. The property, plant, and equipment account. As well, it will affect your cost of sales. As well, it will affect your cost of sales. As well, it will affect your cost of sales. I will mention on how it will affect your cost of sales. I will mention. Before I mention how it will affect your cost of sales, once you have your remaining useful life, remember they said the remaining useful life is what? The remaining useful life is 2.5 years. So when you are given remaining useful life, it means that you have to do what? Depreciation. And if you can look at that additional information, what they said is this. What they said is that the equipment had a carrying amount of 16 million at the transfer date and remaining useful life of 2.5 years. So what you need to know that is that when this anyway, what you need to assume is that when this Keep Limited was transferring this asset to Rima, he had already charged depreciation. He had already charged depreciation. So this Rima receiving this asset, you will again charge depreciation. So there will be a depreciation what? Overcharge. There will be a depreciation overcharge, which is all about UPFA over the remaining useful life. Over the remaining useful life. Over the remaining useful life. Or when you have your percentage, you take UPFA times the depreciation what? Depreciation rate. Depreciation rate. So times the depreciation rate. So meaning that our UPFA is all about 4,000 divided by 2.5. But remember, in this question, there's something I never talked about. When was this under this question? If you look at this question, it's for the financial year ending 30th April. 30th April. Our books ends on 30th April 2024. Our books ends on 30th April 2024. So our financial year starts on 1st May 2023. This Lima was acquired on November during the year. So it's not a full year subsidiary, but it was acquired on November 2023. So from November to the end of the year, those are 6 months. 6 months. From November to the end of the year, those are 6 months. And if you can check on that additional information, the relevant additional information, this additional information number, if you can look at this additional information number 3, they are talking about after the acquisition on 1st November 2023. So that is from November. So your depreciation must be from this period after acquisition. So meaning that I have to multiply 6/12 from November to the end of the year. Those are 6 months. So 4,000 divided by what? Divided by 2. So 6/12 that is divided by 2.5. 4,000 divided by 2.5 times 6/12. So that is 800. That is 800. So we have a depreciation overcharge of 800. So with the depreciation overcharge, with the depreciation overcharge, what you are supposed to do here is, so remember that if there was a depreciation overcharge, it means that there is a profit understatement. This is what we call profit understatement, and at the same time, the asset itself was understated. So the asset was done what? Was understated. Because there is a depreciation overcharge. So when there is a depreciation overcharge, there is an asset understatement, and at the same time, there is profit understatement. Because this is an expense. So we need to adjust those two accounts. We need to adjust those two accounts. So debit, PP account, property, plant, and equipment account. Credit what? Credit retained earnings account. Retained earnings account. Retained earnings account. Credit that. But now, remember that I said, as well, they have to affect what? They have to affect our cost of sales. They have to affect our cost of sales. That is even what they mentioned, that in that relevant additional information, they mentioned that in this additional information here, they mentioned that in note 3, KIB Limited accounted for the gain from its transaction, from these transactions by reducing depreciation expenses. Depreciation is charged to the cost of sales. Depreciation is charged to the cost of sales. So how will this affect what? Our cost of sales. How would they affect our cost of sales? So we have the 4,000, which is the UPFA. We have the 4,000, which is our UPFA, and we have a depreciation overcharge. We have depreciation overcharge. So what you will do with UPFA, you add the cost of sales, and you reduce what? You reduce your depreciation overcharge. So you will add your UPFA and the cost of sales, then deduct what? Deduct depreciation overcharge. Deduct depreciation overcharge. Beside them affecting this account. Beside them affecting these accounts. Beside them affecting those accounts. So additional information number 4, because once we will be done with the additional informations, we'll be just doing our presentation very fast. Additional information number 4. Following the acquisitions, Lima Limited sold goods to Keep worth 160 million. So these are now goods, not fixed assets. So Lima did what? Lima sold goods to who? Lima sold goods to Keep. Selling price, we have 160,000. 160,000, which had originally cost Lima 120 million. So the cost is 120,000. So I'm saying in thousands. I'm presenting these figures in thousands. Of these, goods worth 48 million remained in Keep. Goods remained in Keep. Goods remained in Keep. Goods remained in Keep. 48,000 by the end of the year. As at the end of the year. What are you supposed to do here? Now these goods, goods sold from Lima to Keep. Remember, Keep had acquired who? Had acquired Lima. 75%. So Lima is going ahead to sell goods to Keep. That is an upstream sale. For goods, you need to be careful. Is it upstream or downstream? For the fixed asset, it's obvious from the parent to the subsidiary. For goods, it can be either from the parent to the subsidiary or from the subsidiary to the parent. So this is an upstream sale. So the selling price is this, cost is this. But now by the end of the year, we have some goods remaining in my stock. Remaining, I'm the parent, you are the subsidiary. I have sold goods to you at a profit. But by the end of the year, when looking at your stock, you have some goods in your stock. You have not sold all of them. Meaning that, on my case, you paid me. But on your side, you never sold all those goods. What does it mean? What does it imply? You have not realized the entire profit I realized. There's an unrealized profit on what? Unrealized profit, unrealized profit on stock. On stock, some books say inventory, which must be determined and eliminated. Now here, we have some unrealized profit here. This company already realized entire profit. So profit is overstated in Lima. Profit is overstated. So we need to determine the profit which is overstated here. We eliminate. So that is what I need to determine. So that is, we call it UPS in short, which is unsold goods. Unsold goods times what? Times profit margin. Times profit margin. And here is profit times profit margin, which is, so unsold goods, I know it's 48. So the one in stock. Profit margin, we don't have, but I can determine it. Profit is equal to, I said profit over. So profit margin, remember, profit margin is equal to profit over selling price. Profit, I know, is 48,000. Profit is that. Profit, no, this is unsold. Unsold goods. Profit is the difference. 160 minus, thought about 160,000, the selling price. 160,000 minus 120,000. Over the selling price, which is 160,000. So what do you have there? 160 minus 120, that is 40. Divided by 160. In fraction is a quarter. That is a quarter. That is what you multiply with here. So 48,000 divided by 4. That is 12,000. Simple like that. 12,000. 12,000. So what am I supposed to do? To eliminate this here. And remember, upstream sale. Parent, that is subsidiary to parent. So, and this Lima was not controlled 100%. It was never controlled 100%, meaning that there is 25% NCI, which must be put in consideration when doing elimination. So when doing this elimination, To avoid profit overstatement, and it's good, I know profit must be affected, and I know inventory must be affected. So I'll say debit, credit. So I will credit inventory. I will credit inventory, debit retained earnings, and NCI. So with the retained earnings here, you will say 75% of 12,000. And also there's NCI, because now it's sales upstream, not downstream. So I have to say 25% of 12,000. Then here, full amount, credit with 12,000. So they have to affect these two. As well, they have to affect your cost of sales. These 12,000 must affect what? Your cost of sales. They have to affect your cost of sales. The 12,000 must affect your cost of sales. So you have to debit your cost of sales, debit cost of sales, RIMA limited. RIMA limited, NCI. So the RIMA limited NCI, already I've explained that. So this one here, this 12,000, that is what even I've explained. So I don't have to repeat myself. So it's only that saying, how does they affect your cost of sales? So these 12,000 must be debited under the cost of sales. And I've said you have to credit what? I have to credit my inventory. I have to credit my inventory. Last but not least, before we do just a presentation, which will take less than 20 minutes. Number five. There has been no impairment in goodwill arising from KEEP. So we are told that there is no impairment. All items within the profit or loss and other comprehensive incomes are considered to accrue even throughout the year. So you have to consider the time, the 6 months. Remember that this subsidiary was not acquired as at the start of the year. It was there from November to the end of the year. So it's 6 months. So all items within the profit or loss and other comprehensive income statements are considered to accrue evenly throughout the year. Number 7, non-controlling interest in Lima is valued at 400. So I need to talk about that a bit before we do the presentation. There are additional information. They have said that there are additional information. They went ahead to say that the non-controlling interest was valued at, then NCI is valued at what? NCI is valued at what? Is valued at 400 million. Is valued at 400 million. The NCI is valued at 400 million. So this one implies that when you see that the NCI is measured at a certain value, what comes in your mind is what we call goodwill. So goodwill is all about the economic benefit expected from the usage of an asset. The economic benefit expected from where? The usage of an asset. Economic benefit expected from the usage of an asset. So you can compute goodwill using either full method or partial. You can either compute goodwill using full method, that is under subsidiary. You can compute the goodwill of a subsidiary using either full method or what? Partial method. Full or partial method. You can only use full method when the NCI is measured at fair value. NCI is measured at what? At fair value. Or when the number of ordinary shares, number of ordinary shares in subsidiary, number of ordinary shares in subsidiary are stated at what? Are stated at fair value. Hence, the NCI is equals to number of ordinary shares times percentage of NCI times fair value. That's the fair value of those shares. Fair value of those shares. So you can use full method on this case, but you can use partial method when the NCI is not measured at what? Fair value. When the NCI is not measured at fair value. When the NCI is not measured at fair value. Remember that the non-controlling interest is only available when we have a subsidiary. When we have a subsidiary. Non-controlling interest is the percentage unacquired in the subsidiary. Is the percentage unacquired in the subsidiary. So if you will be computing goodwills of the associates and joint ventures, it's obvious partial. We don't have NCI in associates or joint ventures. So where you need to think, which method am I supposed to use? Is under subsidiary. Am I supposed to use full method or a partial method? You can only use full method on this scenario. You can use partial when we don't have this. When we don't have this. Goodwill arising from the use of full method. Goodwill arising from the use of full method. When computing the goodwill of subsidiary is attributable to both the parent and the non-controlling interest. Is attributable to the parent and the non-controlling interest. But goodwill arising from the computation of goodwill of the subsidiary when using the partial method is only attributable to the parent company. It's only attributable to the parent company. Let's go ahead and do the presentation of this question very fast, because already I have done all the interpretations of the additional informations with the examiner required us to interpret. When yes, it's not a requirement, it's good for you so that you can be able to check on the requirement what they need. Calculate the value of goodwill arising on the acquisition of Lima. So the first thing is all about calculate goodwill. So calculate goodwill. You calculate goodwill as an acquisition of what? As an acquisition of Lima. So here we talk about purchase consideration. Remember we computed purchase consideration already. So the purchase consideration was, I remember it was 1.280. We talk about shillings in thousands. And we go and add the fair value of non-controlling interest, NCI. It was 400,000. So that is, so if you add the two, so 1280 plus 400,000. That is 1680,000. And now less the net assets. Favor of net assets. Fair value. Favor of net assets. Favor of net assets. So the favor of net assets, if you look at your additional information, if you look at your question, well, you are given net assets. You are provided with net assets. You are provided with what? Net assets. So you have net assets. Remember the net assets you use are the net assets of the subsidiary. Ordinary share capital, 640,000. Revaluation share premium we don't have. We have revaluation reserve we don't have. Equity reserves, and we have 8.8. Retained earnings 500,000. Those are the net assets. Remember the net assets of the subsidiary of the investee company. So ordinary share capital. Ordinary share capital. So ordinary share capital is, I can have another column here in thousands. So ordinary share capital is 604,000 as provided in additional information. So there was no share premium and revaluation reserve. There's other equity reserves. So other equity reserves was 8.8. 8.8. Then retained earnings. So when dealing with these net assets, there's no change on this and this. You just pick them direct. But you need to check those net assets provided. the retained earnings in those net assets provided, the retained earning, is it asset acquisition date of that relevant company? Asset acquisition date, as acquisition date. Remember, all those net assets provided were as at 1st November when that company was acquired. So this is okay. The 500,000 is okay. It's provided as at acquisition. It's provided as at acquisition. So you need to be careful. On some scenario, you will be given data to compute the retained earnings as at acquisition date. But for these net assets, they were as at acquisition, as at 1st November, the time when Lima was done what? Was acquired. So 640,000 plus 8.8 plus 500,000. That is 1.148, 1148. So this one you deduct. So 1680,000 minus answer. So the goodwill is equals to 531, 200. That is the goodwill. That is the goodwill. We are done with the first part. I said we'll do it in the shortest time possible when doing presentation. Once we are done with the workings, we do it in less than 20 minutes. The presentations is done in less than 20 minutes. So the next part is all about now doing the statement of profit or loss and other comprehensive incomes. Remember, Keep acquired which company? He acquired Lima. So 75%. So you need to check the time. You need to check the time. That is what you need to do. Remember that our financial year was ending on 30th April 2024. It was starting on 1st May 2023. Lima was acquired on November 2023. So it was here for 6 months. So when I will be considering the items of Lima, I will be apportioning them for 6 months. So we need to check. We need to start by taking the parent plus what? Subsidiary. So Keep Limited, consolidated. So we say consolidated. Statement of profit or loss, and other comprehensive incomes. And other comprehensive what? Comprehensive incomes. And other comprehensive incomes. That is for the year. For the year ended 30th April 2024. 30th April 2024. So here we have shillings in thousands. So we start from revenue, which is the revenue of the parent. Revenue of a Keep, that is 1.8. From a question here, it's 1.8. 1.8 plus that of the subsidiary, 6/12. Now you need to consider this 6 months from November to the end of the year. 6/12 times what? 6/12 times 960,000. Then under the additional information, there was goods which were sold. Remember, there were goods which were sold. That is additional information number. There were goods which were sold. That was additional information number what? There were some goods which were sold. Additional information number. Intergroup sales you have to eliminate. That is the only thing you eliminate under revenue. Intergroup sales. Intergroup sales. Additional information number 4. Additional information number 4. So it's all about, under revenue, it's all about parent plus subsidiary minus intergroup sales. Minus intergroup sales. The sale between parent and subsidiary. That one is not supposed to be considered as a sale. So you have to minus. You have to minus. So 1.8 plus 6/12 times 960,000 minus 160,000. So that is 2120,000. Then you go to the cost of sales. So cost of sales, parent plus subsidiary. So the parent is 1040. That way, that is 1040. Oh, this one is plus. Now you consider 6/12 times 440,000. And now the same amount, the intergroup sales you deducted. You see, these intergroup sales you minus here. Then add the UPS on closing stock. The UPS, we computed UPS. It was the unrealized profit on stock, the one I talked about when I was interpreting my additional information. So it was 12,000. The UPS, unrealized profit on stock. Then I said you add what? You add the UPFA minus depreciation overcharge. Minus depreciation overcharge. That is it. So it's minus intergroup sales plus the UPS based on these goods which were unsold plus UPFA and here is profit on fixed assets minus depreciation overcharge. So that is 1040 plus 220 minus 160 plus 12 plus 4 minus 0.8. That is 1.15.2. That is 11, 15, 200. So that is what you deduct. So the gross profit will be, so 2120 minus 1115, 200. So that is 1004, 800. So that is the gross profit. Then we continue to expenses. We have distribution cost. Distribution cost. So the distribution cost, that is 94,400 plus 6/12 times what? 48,000. So 48,000 divided by 2, that is around 24,000 plus 94,400. So this is 118,400. 118,400. You deduct. Then after that, there is administrative. That is another expense which is present. Administrative cost. So the parent is at what? 10. That is 108, not 10. 108,000. 108,000 plus 6/12 times what? 6/12 times 92,000. So 92,000 divided by 2. That is 46 plus 108,000. So that is 154,000. And after that, we have finance cost. We have the finance cost. So the finance cost, the parent is 6,000 plus 6/12 times 4,800. So that is 6,000 plus 2,400. So that is 8,400. That is 8,400. So up to that point, I can have profit before tax. I can have the profit before tax. So the profit before tax will be so this is 724,000. Then now we minus tax, profit before tax. Then we minus tax, the income tax expense. So the income tax expense, that is of the parent plus subsidiary, 192,000 plus 6/12 times 111. I have the hard copy question here. 111, that is 200. So 111, 200 divided by 2 plus 192,000. So that is 247, 600. 247, 600. So if I deduct that from 724,000 minus answer, so profit after tax, that is profit for the year. Profit for the year. Profit for the year will be 476, 400. So after that, there's other comprehensive incomes. Other comprehensive incomes. According to the question too. So this is based on the question. Other comprehensive income. So other comprehensive income. So the other comprehensive income item. So we have two of them. We have two. The gain on revaluation of rent. Gain on the revaluation of land. But the revaluation is more of an equity component. It's more of an equity component. So other comprehensive incomes, these are incomes which are not related to the generation of business incomes directly. Revaluation is more of an equity component, meaning that when I will be presenting the two values, the parent is 10,000 and this one is 4,000. So this one will be attributable in full. We don't have to apportion the 4,000. We don't have to. It's more of an equity component. So this one will be 14. So that one, we have to take the full amount. It's an equity component. So it's an item of the statement of profit or loss, statement of financial position. So it's an item of statement of financial position. So remember that when we are presenting the items of statements of financial position, even if the subsidiary is acquired 1 month at the end of the year, we don't apportion them. We present them fully the way they are in our books. That is why I am not apportioning this. Then there was a loss. There is one item which is a loss. Loss on what? There is one item which is a loss. It was a loss on loss on fair value of equity financial assets. Loss on fair value. Loss on fair value of equity financial assets. On equity financial assets. So that is more of a, this is an investment in equity instrument. Investment in equity. That is an investment in equity instrument. So that is one type. I'll just be more specific and say investment in equity instruments. So that one you have to apportion. So the values provided is 2,800. See 2,800? Yes, 2,800 plus, so 6 over 12 times what? So 6 over 12 times 1,600. So that is 800 plus, so 2,800 plus, that is 30 what? 36. The total is 36. So this total comprehensive income, So those other comprehensive incomes itself, so before other comprehensive incomes, so other comprehensive, remember this one is a loss. So 14,000 minus 3,600. So that is 10,400. So this is other comprehensive income. So the total comprehensive incomes will be total comprehensive income So now we take 476,400 plus this 10,400. So that is 486,800. That is 486,800. So we have this and we have this. We have that and that. We have profit for the year. So we have to share profit for the year. We have to say this profit for the year attributable to minority shareholders, to NCI, that is, attributable to NCI. And attributable to who? Attributable to parent. And attributable to parent. So what can be attributed? This one, 476,400. So what is attributable to NCI and to the parent? And also I will look at total comprehensive income. I will look at total comprehensive incomes. Total comprehensive incomes attributable to NCI and attributable to what? Attributable to parent. Attributable to parent. So we can do, so remember the total comprehensive incomes here is this one, 486,800. So we can do a small working here to present that, to show that. So we can do a small working there to show how that one is computed. So I'm talking about NCI. So what I'm computing is for what is attributable to NCI. What is attributable to NCI? Based on profit for the year. Profit for the year. So I don't want to waste a lot of time. Profit for the year. Based on profit for the year. And I can say total comprehensive income. So I mean total comprehensive income in short, total comprehensive income. So for the profit for the year, remember that NCI is under subsidiary. NCI is under subsidiary. So for the profit for the year is 264,000. But remember, this subsidiary was a subsidiary for 6 months. So it was a subsidiary for 6 months. So that is 264,000 divided by 2. So that is 132,000. So we need to start with profit for the year, then we adjust it. So dash. Then for the total comprehensive incomes, I can adjust this direct by saying this. Now that we have the 264. But now under total comprehensive incomes, there's other comprehensive incomes items. We have the 4,000 and the 1,600. 4,000 and the 1,600. So we have to minus the 1,600, which was a loss. These are loss there. But remember, we have to consider the months, 6/12. We have to consider the months. Then add the 4,000. Add the 4,000. Again, add the 4,000. Add the 4,000. So 264,000 minus 1,600 divided by 2 plus 4,000. That is 135,200. So the only thing you adjust with here is the only thing which is present, which will be adjusted, because here we always consider UPS if upstream sell. But yes, there was UPS due to upstream sale, but they were very specific where it where it will be adjusted. There's unrealized profit on the goods which are unsold, but they mentioned something on the UPS that is based on additional information number. No, that is the only thing we will consider. The one I'm talking about is note 3, the depreciation. So for the UPS, we have to adjust because they were not specific. They just say, following the acquisition, Rima Limited sold goods to KIP worth 160 million, which had originally cost Rima 120. Of these goods, worth 48 million remained in KIP Limited's inventory as at year end, and it was due to upstream sale. So that one must be adjusted accordingly because NCI is affected. NCI is affected. It's an upstream sale from the subsidiary to the parent. So here we have to consider unrealized what? Unrealized profit on stock. So due to upstream sale, due to upstream sale. Remember it was 12,000. So we have to minus because this profit is overstated. This profit is overstated. This profit is overstated. So if there was a depreciation overcharge, you minus. Depreciation overcharge, you deduct. Yes, there was depreciation overcharge. There was depreciation overcharge under note 3. That is the one I was talking about earlier. There's a depreciation overcharge, but they said KIP Limited accounted for the gain from these transactions by reducing its depreciation what? Expenses. Depreciation is charged to where? To the cost of sales. They were very specific. They were very specific. So you minus depreciation overcharge if they were not specific, minus depreciation overcharge. Depreciation overcharge, add depreciation undercharge, add depreciation undercharge. Depreciation undercharge can only arise if there's revaluation gain, then deduct impairment if it was present, and on the scenarios where we used full method. So we don't have those items. So adjusted profit, our adjusted profit here is 132,000 minus 12,000. So that is 120,000. That is 120. 135,200 minus 12,000. So this is 123,200. So that now NCI profit will be. So now you apply 20%. It was 20 or 25. It was 25%. Because the parent acquired Lima up to 75%. So 25% of this. 25% of 120 is 30,000. And for 123, 200 is 3,800. So for the profit for the year, this is NCI is 30,000. So that the balance, remember that now here profit to parent will be the balance. You take 476, 400 minus the 30,000. Minus the 30,000. So 476, 400 minus 30,000. So that is 446, 400. 446, 400. For other comprehensive income, remember this is 3,800. So for the balance, so you take 486, 800 minus 3,800. So 486, 800 minus 3,800. So that is 456. The balance is 456,000. 456. 450 what? 456,000. So that is how you were supposed to get your 12 marks. That is how you were supposed to get your 12 marks. But it's not a must that you have to score everything. You have to do all entries correct. But when they mark this way. Like now, these 12 marks, they were marking this way. They were marking this way. So this is a mark. So this is a mark, this is a mark, this is a mark, this is a mark, this is a mark. They mark this, they don't mark totals. They mark this, they mark this. They don't mark totals. They mark this and this, and this and this. So out of the 12, this was having how many marks? 12. So this one was having 12 marks. Eh? So out of 1, 2 entries, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. They needed only 6. You see, out of the 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. They needed only 6 entries. 6 entries. They multiply by 2. They multiply by 2, you get your 12 marks. Get your 12 marks. So it's not a must that you score everything correct. Eh? It's not a must you score everything correct. They needed only 6 entries out of what I have done so that you get your 12 marks. So that marks the end of the session today. For the new students are around, if you want to join my online class, we'll be doing classes from now until April. Until April. Use this number. This is my number. This is my contact. You can contact me so that you can join. So for the guys who are outside Kenya, you know that you add 254. The guys like now from Rwanda. The likes of Fidel. Eh? You can use WhatsApp. Eh? So Fidel, how are you? Moses, how was the session today? Victor, Wilfred, you can comment. You can add something before we close, before we end the session. Yes, Fidel. Anything from Fidel, anything from Moses, anything from Victor, anything from Wilfred, anything from the other guys who are around. Silence means that you are okay with what we have done. We'll be doing classes on Wednesday and Thursdays for financial reporting and analysis. Tomorrow we have a class. I will be introducing agriculture and farming activity, the agriculture. So Wilfred, you have said very nice. I need full concentration to capture everything. So you are welcome. You can, yes, when you are in this class, Zoom session, these are virtual sessions. Assume as if you are in a normal class. The concentration you give in a normal class, that is what you are supposed to do. So give it all the effort. Give it all the effort. It's just 2 hours, and you can do other things. So what I'm saying is that tomorrow we have another session for the guys who are in the group. That is my students. And for anybody who would like to join, here's the number. So good night. See you tomorrow.